Thank you so much for joining us here on a Monday. I'm Marlon Bowling with you, watching your ag commodity trade and some new USDA numbers that just came out here to help us analyze the latest action and data that has come out. Let's go to the phones and talk with Brian Splitt. Now, Brian happens to be with Allendale Incorporated in McHenry, Illinois, a regular contributor here on the show, and good to have you back here, Brian. Let's take a look at some new export inspection numbers that just came out from USDA. They're still hot off the press here, so let's take a peek. All right, this past week, we actually shipped out of the nation corn at 1.18 million tons. Now, that compares with the previous week when we had a total of 1.19 million, so almost identical. I was looking back at last year's number, and it was 1.07 million. On the sorghum, we had a total of 144,456 this week, compared to the previous week when it was 121,397, so a slight uptick there. Soybeans, only 277,298. That compares to 350,500 the week before. Now, there is a caveat there because a year ago that total was only 98,000. On the wheat, 522,881. The previous week, 604,500, and a year ago that number was 391,207. So let's talk with Brian Splitt about what's going on here with the markets today. Now that the export inspections numbers are out, can you take much away from that?
I think the most important number that the trade's going to continue to be watching very closely are the soybean inspections, just due to the large amount of unshipped soybeans that have been purchased. So there's a large book of purchased soybeans that just haven't left the country yet. And as we approach the end of the marketing year, which for grains is going to be in September, as we approach the end of the marketing year, it's going to be important to try and figure out how many of these purchased soybeans will actually leave the country and how many are just going to be rolled into new crop purchases, thereby potentially adding to the overall carryout assumptions.
Now, we did have a firmer tone here on the grains to get everything started here on Monday. Let's take a look at our corn market right now. And on live quotes direct from Chicago, we have that July contract currently at 374. So now we're a penny and a quarter higher. We did get as high as 375.5. December 392 3/4 right now. That's 1 3/4 cents higher. What do you think we're going to see for the crop condition ratings when they come out this afternoon from USDA?
I'd have to imagine that things have improved nationwide over the past week, so I wouldn't be surprised to see the good to excellent ratings achieve 70% or higher by this afternoon.
How would that compare to an average, do you know?
Versus the 5-year average, I'm not quite sure where that puts it, but we've seen numerous years where the first rating was below 70% good to excellent. I think 9 in the past 20 or so, and 5 out of those 9 still achieved some higher than trend yields. So the USDA is going to place much more importance for their yield models on weather during the month of July than anything else.
Okay, let's look at our soybean trade on the big board right now on soybean futures. Here's a look at July, where we're 3/4 higher at 922, and you have your new crop November 4 higher at 929.5. There was a little more enthusiasm in the soybean trade earlier today there.
There was, and it all kind of backed off when those inspections came out, and that unshipped book of soybeans, that's again going to be a major concern for soybeans. But we've got a lot of things going on, big picture right now. The funds are heavily short. We've seen the funds heavily short corn and soybeans this time of year before, and it generally will lead at some point to them trying to gracefully exit their short position and go long. I would venture to say there's probably about 200,000 contracts of soybeans that will be bought in the next 30 to 45 days, and I would estimate maybe about 400,000 contracts of corn that will be bought in the same time frame if my thoughts are correct.
Okay, let's look at the wheat in Chicago. July wheat, we're currently trading just a half lower at 429. Kansas City wheat on that July contract is now down 2.5 at 430 3/4. It had been about a nickel higher than where it is now. Minneapolis wheat has been trading firmer, though. We have July up 3 3/4 at 587.5, and in the cotton market right now, July is down 25 points at 76.44. We'll come back in just a moment, and we're going to talk more with Brian Splitt about our livestock trade when we come back on the other side of this message. Come on. Well, we're back with you here on the Market Day Report. I'm Marlon Bowling with you, and we're talking with Brian Splitt of Allendale Incorporated. Now, let's take a quick peek here at this crude oil market and also the heating oil trade before we get into our livestock. Crude oil market is down today. I thought you should know about this. July futures on the West Texas crude are down 65 cents now, trade at $47.01. Barely hanging on to $47. It had a high of $48.42 and a low of $46.86. So a fairly wide swing here in the price of West Texas crude. Currently down now well over a half a dollar. On the heating oil side, that means we have the July now down 2.8 cents at 145.7. We're talking with Brian Splitt of Allendale in McHenry, Illinois. Any words of wisdom here for guys that are thinking about, should I add to my diesel fuel purchases this year or not? Is this a good time or not?
In the big picture for fall future values, and I'm looking at the October-December time frame, we really have been in a sideways type of a trading range over the past year, and we are towards the lower end of that range. So if you're looking at the December heating oil futures near $1.50, that has been good support value for that contract. You don't want to be locking in heating oil values when you're in that $1.70, $1.80 zone. So being a range-bound market, it's something to pay attention to, being at the lower end of that range.
Okay, let's switch over to the live cattle board. And if you recall, Friday, we ended with the live cattle on that June contract sharply higher, but that went into delivery mode today now. First notice date today on that contract. It's up $1 at 131.82. The other month's much more timid. August is now 20 cents higher at 126.25. October up 30. On the feeder cattle side, right now you have your August contract $1.38 higher at 160.10. September up $1.78 at 159.60. And actually you have October on out over $2 higher today. So the most strength in the feeder cattle market being shown in the deferred contracts. That's different for a change.
Yeah, and we're seeing a little bit of the same in the live as well. The very front month, June, is leading the charge, but overall it's a market that's being bear spread. August fats are only up 5 points, and some of the contracts out to next summer are up as much as $1 or more. So little bit of change of pace here. I think they needed to get this June contract up close to where the cash is expected to trade, so it's not a surprise to see some 132 futures traded a little over that today. The Fed Cattle Exchange will give us some current values on Wednesday morning, and we'll see where we go from there.
On the lean hog trade right now on the futures, we currently have the June contract down 60 at 80.62. The more active July contract is down 63 now at 81.35. I will throw a word of caution in there. It has been on both sides of unchanged today, but we're getting very close, only one tick away from our low of the day right now. Brian, good to visit with you. I appreciate it, sir. Brian Splitt is with Allendale, and he is based in McHenry, Illinois. So a little weakness creeping into the hog market for the time being.
For the time being.
Yep.
Interesting how things can change so dramatically, so quickly.
It could happen all day.
Okay, thank you so much, Markets Editor Marlon Bowling.